What if I told you that the biggest stock market crashes in history weren't random, but profitable patterns? That the same playbook, used by few powerful investors, turned the Great Depression, the 2008 financial crisis, and even today's markets into billion-dollar opportunities? This isn't conspiracy. It's history repeating itself, almost mathematically. In 1929, Joseph Kennedy turned $4 million into a fortune by exiting the market just months before it imploded. In 2008, Michael Burry bet against the housing bubble and made $700 million when everyone else went bankrupt. And right now, in 2025, the same indicators, the same rhythm of greed, leverage, and illusion are flashing red again. But here's the twist. These investors didn't just predict the crashes, they engineered their escape by understanding one repeating pattern, a four-stage cycle that always ends the same way. The crowd loses, and the patient few become legends. So, what is this crash profit pattern? How can the same sequence of human behavior and market manipulation make fortunes nearly a century apart? To find out, we have to go back to where it all began. The year is 1929. The Roaring Twenties are in full swing. Radios, automobiles, skyscrapers, they define a new era of American prosperity. Everyone, from Wall Street bankers to shoeshine boys, is buying stocks. The Dow Jones has tripled in just 5 years. Leverage is everywhere. Brokers offer 10-to-1 margin. You can buy $10,000 worth of stocks with just $1,000 cash. To the public, it's free money. To the insiders, it's a ticking time bomb. Joseph P. Kennedy, yes, the father of future President John F. Kennedy, saw through the illusion. According to legend, one day his shoeshine boy gave him stock tips. That's when Kennedy knew it was over. When even the shoeshine boys are giving stock tips, he said, it's time to get out. And that's exactly what he did. Kennedy quietly sold his holdings. He shorted the market. And when the crash came, he walked away richer than ever, while millions lost everything. But was that luck or something else? Because if you zoom out, Kennedy's move fits perfectly into stage 4 of the crash profit pattern, the exit and exploit phase. To understand that pattern, we need to see the full cycle. Stage 1. The spark. It always starts with innovation. Something new, exciting, revolutionary. In 1920s America, it was automobiles, radios, and margin trading. In the 2000s, it was subprime mortgages and credit derivatives. Today, it's AI stocks and digital finance. Stage 2. The mania. Prices surge. Credit expands. Everyone feels like a genius. Media calls it a new era. Warnings are ignored. Stage 3. The stress fracture. Small cracks begin to appear. Liquidity tightens. Defaults rise. One key institution falters. The crowd dismisses it as temporary. Stage 4. The collapse and profit. The insiders exit early. The crowd holds the bag. The crash cleanses the system. The few who understood the cycle re-enter at the bottom, buying assets at pennies on the dollar. This cycle has played out every few decades with shocking precision, and in each cycle, one group gets wiped out, while another becomes mythic. So how did it start? What triggered the first modern crash in 1929? And how did Joseph Kennedy, Jesse Livermore, and a few others see it coming, while the rest of the world danced on the edge of financial ruin? To answer that, we'll dive into the origins of the first crash profit pattern, the 1920s bubble, the psychological traps that fueled it, and the early warning signs that most ignored. Because understanding the past isn't just about history. It's about seeing the same storm forming again. Right now. The year is 1925. The U.S. stock market is unstoppable. Every headline screams opportunity. Newspapers call it the American dream in motion. Investors call it of permanent prosperity. Factories are booming. Banks are lending. And the Federal Reserve? They're fueling it all, quietly lowering rates to keep the good times rolling. It's the perfect setup for stage one of the crash profit pattern, the spark. The spark wasn't just economic growth, it was belief. Belief that the modern world had conquered risk. Belief that progress could only go one way, up. And that belief turned into mania. By 1927, everyone was borrowing to invest. Secretaries, factory workers, even farmers, all pouring money into the market. Wall Street was the new gold rush. You could buy $100 worth of stock with only $10 down. Margin debt exploded to record highs. The market had become a casino, and everyone was all in. Joseph Kennedy once said, "Only a fool holds a winning hand forever." He knew how fast the tide could turn, but most didn't. Then came stage two, the mania. Stocks like RCA, the radio company, rose 10x in just a few years. People believed radio would change the world forever, and it did, but not fast enough to justify those prices. When skeptics warned of a bubble, they were laughed at. Magazines declared, "Stocks have reached a permanently high plateau." Sound familiar? It should, because the same words were used again in 2007. But every mania has its first crack, the stress fracture stage. In late 1928, the Federal Reserve noticed the danger. Speculation was out of control, so they raised interest rates to cool things down. Liquidity started drying up. Borrowed money became expensive. Some investors began selling to cover their debts. Tiny cracks, barely visible, but growing. By summer 1929, even big names were nervous. Jesse Livermore, the legendary trader, started quietly shorting the market. Kennedy followed. They both saw what others ignored. When everyone's confident, danger is near. October 1929. The music stops. On Thursday, October 24th. Black Thursday. Panic hits the floor of the New York Stock Exchange. Billions in value vanish within hours. 5 days later, Black Tuesday strikes. The market collapses completely. People flood Wall Street in disbelief. Brokers jump from windows. Fortunes evaporate overnight. But not for everyone. Joseph Kennedy, who exited months before, buys assets for pennies on the dollar. Jesse Livermore, who shorted the crash, makes over $100 million, a staggering amount at the time. They didn't predict luck. They followed logic. They knew the pattern. When greed peaks, credit tightens, and confidence turns to arrogance. Collapse is inevitable. What followed was the Great Depression, the longest and deepest economic collapse in modern history. Unemployment soared to 25%. Banks failed by the thousands, and the same financial elite who caused the bubble walked away with power, cash, and assets. The public blamed bad luck, but the insiders knew this wasn't luck, it was strategy. Stage 4 of the crash profit pattern had played out perfectly. And as America struggled through a decade of pain, the few who understood the cycle quietly rebuilt empires. Kennedy used his fortune to become head of the SEC. He helped write the very rules that would protect, and sometimes enable, the next generation of financial manipulators. Fast forward nearly 80 years. The names have changed. The tools have evolved. But the pattern is the same. Because the same ingredients that fueled 1929 returned in 2008, just dressed in modern clothes. Cheap money, new financial innovations, excessive leverage, and blind faith that this time is different. Sound familiar? It should. The 2008 financial crisis was not a surprise to everyone. A few saw it forming years before, and just like Kennedy and Livermore, they positioned themselves not to survive, but to profit. Enter Michael Burry, a soft-spoken doctor turned hedge fund manager. In 2005, while the world was buying homes and celebrating endless growth, Burry was reading mortgage data. Line by line, he discovered something no one wanted to see. Banks were giving massive loans to people who could never repay them. These loans were being repackaged into bonds and sold to investors as safe assets. Burry saw through the illusion. He realized that when these homeowners began defaulting, the entire housing market and the global banking system would collapse. He started shorting the housing market using something new: credit default swaps, a revolutionary way to bet against the financial system itself. His investors thought he was insane. Wall Street mocked him. But Burry wasn't wrong. He had simply recognized the next iteration of the crash profit pattern. By 2007, the cracks appeared. Home prices started falling. Banks began to panic. And the entire structure, built on leverage and lies, started to tremble. The final phase had arrived: the collapse and profit. In 2008, Lehman Brothers went bankrupt. The market crashed. Trillions were wiped out. But Michael Burry's fund made nearly $700 million. It's just like Kennedy in 1929. He profited from collapse because he understood the rhythm. The question is, if it happened in 1929 and again in 2008, what does that say about today? Because the same forces, cheap credit, speculative mania, and unshakable confidence in new technology, are building again. The names are different: AI, crypto, fintech, meme stocks. But the psychology is identical. The spark has already lit, and we're deep into stage 2, the mania. History doesn't repeat exactly, but it rhymes: in money, in greed, and in fear. And right now, in 2025, that rhyme has become a loud echo. The same pattern that made Joseph Kennedy rich in 1929 and Michael Burry a legend in 2008 is quietly playing out again. Most people can't see it. They're too close to the noise, too hypnotized by record highs, AI miracles, and promises of a new economic era. But the smart money, they've already started to move. Let's look at where we are right now. In 2020, the Federal Reserve unleashed the largest monetary stimulus in history. 0% interest rates, unlimited bond buying, trillions of dollars printed. It was the perfect stage 1, the spark. And what was the innovation this time? Artificial intelligence, digital currency, and the idea that technology had made old economics obsolete. Money was cheap, risk was forgotten, and greed returned, louder than ever. Stocks surged, crypto rebounded, real estate soared to record highs. It was the rebirth of the 1920s mania. Only this time, it lived inside screens and algorithms. Stage 2, the mania, took over fast. Retail investors flooded back into markets. Day trading apps made speculation feel like gaming. AI-driven funds promised risk-free returns. Everywhere you looked, someone was getting rich overnight. Social media turned speculation into culture. Influencers bragged about 300% gains. Everyone became an investor, just like 1929, just like 2008. Because at its core, every bubble is built on the same human illusion. This time, it's different. But cracks are already forming. Inflation that was supposed to be temporary is now eating away at every paycheck. Global debt has reached $320 trillion, the highest in human history. Interest rates, once near zero, have climbed to multi-decade highs. Corporate defaults are quietly rising. Commercial real estate is collapsing. And the bond market, the lifeblood of global finance, is flashing warning signals not seen since 2008. We're entering stage 3, the stress fracture. The first signs aren't dramatic. They're subtle. A hedge fund quietly failing here. A regional bank collapsing there. Liquidity drying up in corners of the system that the media ignores. But insiders are watching closely. They've seen this movie before. Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." And right now, the tide is going out. Corporate buybacks are slowing. Tech valuations are stretched to extremes. AI companies are trading at 100x earnings, numbers that only make sense in a fantasy. Investors are trapped in a feedback loop of optimism. They don't want to believe it can end. But the pattern doesn't care what anyone believes. It always finishes the same way. Look closely, and you'll see history replaying in real time. In 1929, they said radios and automobiles had changed everything. In 2008, they said financial engineering had eliminated risk. In 2025, they say artificial intelligence has rewritten economics. Different technology, same psychology, and behind the curtain, the same type of players are preparing. Hedge funds are building short positions. Banks are shifting to cash and treasuries. Even the Federal Reserve is quietly draining liquidity from the system. They know what comes next. Stage 4, the collapse and profit. But here's the thing about crashes. They never look like crashes at first. They start slow. Confidence fades quietly. Markets wobble. Then suddenly, everything breaks at once. It's never one event. It's a chain reaction. A bank defaults. A fund blows up. Credit tightens. Fear spreads. Then prices fall faster than anyone thought possible. Margin calls wipe out traders overnight. News anchors panic. Politicians blame unforeseen circumstances. But it's not unforeseen. It's the pattern. Remember 1929? The shoeshine boy giving stock tips. Remember 2008? The waitress buying her third investment property. And now, people on TikTok teaching how to trade options. How to 100x your crypto overnight. How to get rich risk-free with AI bots. The characters change, the setting changes, but the story stays the same. So, where exactly are we right now? We're between Stage 3 and Stage 4. The cracks are spreading. Liquidity is tightening. But the crowd still thinks the party will never end. This is the most dangerous moment, because it feels safe. Markets are near all-time highs. The economy looks fine on the surface. But underneath, debt is choking the system. Consumer savings are collapsing. Banks are hiding losses on their balance sheets. And the Federal Reserve is trapped. Raise rates, and they break the system. Cut rates, and they unleash more inflation. There's no clean exit, only consequences delayed. This is exactly how every bubble ends. First comes innovation, then euphoria, then stress, then collapse. And always, the same people profit. Because they don't follow emotion. They follow structure. They recognize the rhythm. They understand when the market stops being rational and starts being reflexive. They don't fight the cycle. They ride it. Just like Kennedy, just like Burry, and just like a handful of investors today, who already see what's coming next. Every great market collapse has a quiet countdown. It starts long before the headlines, and right now, that countdown has already begun. The question isn't if the next crash will happen, but who is preparing for it. Because make no mistake, the same pattern that enriched Kennedy in 1929 and made Burry a legend in 2008 is once again unfolding, step by step, in 2025. And while the public chases quick gains, the insiders are positioning for the opposite. Take a look at the data. The Federal Reserve's reverse repo facility, once holding over $2 trillion in excess liquidity, has been draining fast. That's not just a statistic. It means cash is leaving the system. Liquidity, the oxygen of markets, is thinning. Meanwhile, corporate debt is at record highs. Government spending is out of control. And global bond yields are at their highest in decades. It's the same cocktail that triggered 1929 and 2008. Too much leverage, too little liquidity, and way too much confidence. Yet the mainstream narrative stays the same. Analysts call this a new cycle of growth. Tech CEOs say AI will create limitless productivity. Politicians promise soft landings and temporary corrections. But remember this. In 1929, they said the same. In 2008, They said the same. The pattern is psychological. It feeds on denial. Every bubble is powered by one emotion, hope, and hope is always strongest just before it dies. Insiders know this. They know that markets don't move on facts. They move on perception. So they don't wait for the crash. They anticipate it. They see the early signals, the flattening yield curve, the shrinking money supply, the silent stress in interbank lending. They see the same shadows Kennedy saw before 1929, the same warning lights Burry saw before 2008. And right now, they're moving money quietly, out of high-risk assets into cash, commodities, and short positions. Because they understand what's coming. The next phase won't start with a bang. It'll start with silence. Maybe a small default overseas. Maybe a tech fund imploding. Maybe a temporary liquidity event. The media will say, "Don't worry, it's contained." But it won't be. Confidence will crack. Margin calls will trigger. Algorithms will sell automatically. And just like that, billions will vanish overnight. We've seen it before. We'll see it again. When the dust settles, the same pattern will repeat one last time. Assets will collapse to unimaginable lows. Fear will dominate the headlines. Investors will swear they'll never touch stocks again. And that's when the real players strike. They'll buy everything, the same way Kennedy bought in 1932, the same way Burry bought back housing assets in 2010. The cycle completes, and those who understood it profit again. Because this isn't just about markets. It's about human behavior. The crash profit pattern exists because humans never change. We chase what's rising. We fear what's falling. We forget what we learned. Technology evolves, regulations shift, but greed, fear, and denial, they're constants, and that's why the pattern keeps working. So where does that leave us today? Right now, we stand in the late stages of the cycle. The spark has long ignited. The mania has already peaked. The stress fractures are spreading, and the collapse phase is approaching fast. It may not happen tomorrow. It may not happen this quarter. But it will happen. The question is, will you see it coming? Because once you recognize the rhythm, you stop being the victim of the cycle and start being the observer of it. That's how the insiders play. They don't fight emotions. They anticipate them. They don't buy hype. They buy panic. And they don't listen to headlines. They listen to history. Here are 3 takeaways from the crash profit pattern. First, every boom begins with innovation, but ends with speculation. Whether it's automobiles, mortgages, or AI, the story never changes. Second, crashes don't destroy wealth, they transfer it, from the impatient to the informed. Third, the next crisis won't be about banks or housing. It will be about trust. Trust in the system, in the dollar, in institutions. And once that cracks, markets everywhere will tremble. We've seen this movie before, 1929, 2008, and now it's playing again. The cycle always ends the same way, with panic, then opportunity. The only question left is, which side of the pattern will you be on? If you found this story eye-opening, don't forget. History doesn't just teach us what happened. It warns us about what's coming. So stay curious, stay skeptical, and remember, those who study the past aren't surprised by the future. They profit from it. This is the crash profit pattern, and it's unfolding again, right now.